Hello, CUNA Chief Economist Mike Schenk here with a brief high-level overview of our newly minted economic and credit union forecast, which we've posted on the CUNA website at www.cuna.org/economics. All the details related to the forecast, the underlying assumptions and so forth are spelled out very clearly in that information that's posted on the website. So I urge you to go there to get a bit more background information if you'd like that. But essentially, our forecast is, in the scheme of things, I think, hopeful. Before we start looking at economic data, one of the things that I wanted to mention that we look at on an ongoing basis, because it's one of the best real-time data sources that we have, that tells us something about the trend in the healthcare crisis itself. And of course, there are implications related to the economy associated with that trend. So this is data from Johns Hopkins University. And I include the URL so that you can look at this data at the state level and at the county level and see exactly how things are trending in your particular geographic area. Because as you know, there's an incredible amount of variation in all of this data, and that variation has something to do with when and where things are opened up and when the economy gets back on track. So be sure to look at local data when you think about the way forward, and especially as relates to the healthcare issue, of course. The data that I have here represents the increase in the number of cases recorded each day. I've averaged them out over 5 days so that the graphic here is smoothed out. The numbers don't jump around a lot. And essentially the good news is that this is showing us that the curve really does seem to be flattening. The White House protocol calls for 14 consecutive days of declines in this line before we can safely assume that we're out of the woods. Obviously that has not happened yet, but I think what this data shows is that we can probably expect that to occur sometime within the next 2 to 3 weeks. So the social distancing is having a desired effect. We are approaching what will not necessarily be the end of this crisis, may not be the beginning of the end of this crisis, but to quote Churchill, may be the end of the beginning. And that actually is good news. We'll have to lock in the gains, of course, with wider spread testing, perhaps the availability of a vaccine, and in the absence of those things, of course, continued social distancing to the extent that this phenomenon is obvious where we live. So this is the first piece of data that we look at when we think about the economy. It does provide hope that we're headed in the right direction and that our baseline assumption is probably correct, that the worst of this will be behind us by the middle of this year. So we're expecting the nasty economic consequences to have been sort of fully incorporated into data by the end of June this year. That doesn't mean, again, that we're done with the crisis. There more than likely will be a couple of humps. We may be revisiting some issues in the fall or early next year, but most of the ill effects will be associated with what happens in the first half of this year. Now, when we think about the economy, our forecast really has not changed much in the last month or so. This is the worst economic catastrophe since the Great Depression. We've been saying that now for several weeks. Our updated forecast continues to reflect that. The US economy contracted at a rate of 5% annualized in the first quarter. Our baseline expectation calls for further contraction in the second quarter equal to 35% annualized. Now, for the full year, we think the economy will contract at a rate of about 4%. And then into 2021, actual economic growth in the neighborhood of 3%. So I almost hesitate to say that because I don't want to give you the impression that because the economy is contracting this year and then growing next year, that we think this is going to be a V-shaped affair. On the contrary, we believe this will be a U-shaped downturn if we're lucky, And if not, it will be an L-shaped downturn. And it has a lot to do with the graphic that you're seeing before you now. And this is data for weekly unemployment insurance claims, a historically unprecedented development in the last 6 weeks when the US economy basically shed over 30 million jobs. Now, I have a URL for a website. This is national US data website, a US government data website, which shows state level information. So you want to be looking at this stuff at the state level. And actually, if you Google unemployment insurance weekly claims and then insert the name of your state, that more than likely will get you to the Labor Department in your respective state, or sometimes it's called the Bureau of Employment Security or something like that. Essentially, you'll be able to get not just state level data in most cases, but also county level data. So credit unions that operate in specific counties can track this sort of thing. Very, very important. And by extension, many of those organizations, state departments, will also provide data at the industry level. So to the extent a credit union has a narrow field of membership serving a specific industry, that data at the state level may also be available. So you definitely want to check that out. This is really a severe disruption, again, unprecedented in modern US history. And to put it in relative terms, so abstracting from the overall numbers, if we look at this as a percentage of the labor force, it suggests that the US unemployment rate today is at 23%. Our forecast calls for this to peak out at around 25%, gradually improve, and then finish next year at 10%. Now the PPP, the SBA's Paycheck Protection Program, will dampen these numbers down a little bit. But the real, I think, important thing to remember is that whether it does or not, this is a significant portion of the labor force that has been disrupted, and there will be long-term consequences for this level of disruption for long-term financial health, for things like mental health and physical health and substance abuse and so on and so forth. A really big deal. From a labor market perspective, it means that our members are not going to only be under stress for a little while, but that they will feel the effects of this well past our forecast horizon at the end of 2021. For credit unions, what does this mean? Well, it means a substantial dislocation from a financial and operational perspective, not surprisingly. We believe that interest rates will remain very, very close to zero throughout our forecast horizon through the end of 2021. That will put substantial additional downward pressure on net interest margins, primarily because asset yields will be declining and declining significantly. The asset yields, of course, are affected by low interest rates, very close to zero, on the one hand, but also affected by the fact that deposit growth has been quite strong due to stimulus payments in part. That strong deposit growth translates to strong asset growth. The assets that we're putting on the books, generally speaking, in the context of weak overall loan demand, are short-term investments that yield very close to zero. So falling asset yields and more pressure on asset yields are very, very significant because asset yields account for about 75% of credit union bottom line results. We're seeing significant dislocations with fee income. NSF income has fallen dramatically. And we're seeing big dislocations with things like the income that's related to interchange, which has also fallen dramatically. Each of those two things that I just mentioned represents somewhere in the neighborhood of 5 to 7% of gross income at credit unions nationally. Of course, the other aspect of this is that almost everybody is expecting asset quality to deteriorate significantly. And most of the people that I talk to are expecting that pain and suffering to be most obvious, not this year, but in 2021. And so that suggests that loan loss provisioning will increase dramatically and affect bottom line results. The good news is that credit unions went into this downturn in relatively good shape overall, with 2019 operating results that we're at cyclical highs essentially. Asset quality, both in terms of delinquency rate and net charge-off rate, was right around cyclical highs. I believe the delinquency rate actually was near an all-time low, and ROA was 93 basis points overall. That was a cyclical high. So great news there. The capital ratio was almost 11.5%, and that meant that credit unions really collectively entered this crisis in good shape. So in better shape than in the recent past, and more credit unions because of this will be able to weather this crisis. You can see this is our credit union forecast in the far right-hand column here. We are expecting ROA to fall from that 93 basis point cyclical high to only 30 basis points this year, and then we expect credit unions collectively to go in the red next year, recording in the aggregate a negative 10 basis points ROA. And of course, that will mean, in combination with the fast asset growth, that net worth ratios will be declining, beginning this year at 11.4%, ending next year at about 9.5%. So again, a reflection of significant strain going forward. There's the data that shows what happened in 2019, and follow that across to the right side of the page, and you can see those dislocations that I just described. We are looking at a granular level the stressors that credit unions are faced with. We are looking at things like whether or not the COVID crisis itself is a big deal geographically for individual institutions, what their baseline earnings look like, things like whether or not they're exposed to particularly vulnerable sectors of the economy, like the energy sector, the tourism sector, and that sort of thing. And when we do that, the bottom line result is that we do not expect there to be a big spike in credit union failures, despite the severity of this crisis. We do expect there to be an increase in consolidation going forward. It won't happen all at once. It will happen over time. And the biggest spike in consolidation, if history is a good guide, will occur not during the teeth of the crisis, but in the wake of the crisis. So 2 or 3 or 4 years down the line, we will tend to see the biggest increases. In any case, we have a variety of tools in addition to the information on the baseline forecast. We have a variety of tools on our website, www.cuna.org/economics. This is one that I've been urging most credit unions to check out in the not too distant future. It's our capital planning analysis. It's a crisis version of that analysis, and essentially allows credit unions to pull in their data by typing in their charter number, pull in their data to the calculator, see what happened to their credit union during the Great Recession, so the last time that there was significant stress, and then see how resilient, based on that data, how resilient their credit union will be going forward under assumptions that relate either to the last recession or to better forecasts that they can come up with internally. So essentially, we take credit union ROA at various levels, credit union growth rates at various levels, and then project out into the future, 1 year, 3 years, 1 year, 2 years, 5 years into the future, what the net worth ratio will look like. So that really gives managers, and more importantly, I think credit union directors, a better understanding of the relationship between those numbers and expectations for the amount of engagement with members that the credit union can afford. And when they do this, I think most are pleasantly surprised with how resilient their credit union will be, and will, I think, as a consequence, be more confident in interacting with members going forward, helping members to the extent that they can in very significant ways, get them to the other side of this crisis. That's what we've done in the past. I have no reason to believe, based on the data that we're seeing today and this baseline forecast, that we won't be able to do that in the future. And there will be a payoff. If history is a good guide, again, the payoff will be that more and more people who are not credit union members today will join credit unions, and in record numbers in the wake of the Great Recession, we saw membership growth that basically came in at 4, 5, 6 times the rate of population growth. We expect that to happen again going forward. So that in a nutshell is a very high level view of what we're thinking at the moment. We will of course be updating this forecast on an ongoing basis, reposting these short overviews. In the meantime, if you have any questions, or if you need to contact me, please do so. My contact information is on the front of this slide deck. Don't hesitate to do that. If you email me, be sure to email at the same time, custat@cuna.coop, custat@cuna.coop. And then all of the people that are associated with numbers crunching and data collection and analysis and that sort of thing can be involved in the conversation and can help you out. So thanks for joining, stay safe, and I hope to see you again soon. Take care.